Welcome back, ladies and gentlemen, to Lotus Resources channel, forefronting uranium exploration with proven producers. Joining us today is the Managing Director, Keith Bowes. Welcome back, sir.
Thank you very much for having me back. Great to see you again.
And great to see you as well. We got lots to dive into today. I mean, first and foremost, you guys updated your Kayelekera operation. You increased resources by 23% to 46.3 million pounds of uranium. Offer some insights here.
Sure. So there was really two pieces of work that contributed to the increase in that resource. So first of all, we've spoken about previously the exploration program that we did. So we did a drilling program where we looked at extending the periphery or extending the boundary of that resource. That was a successful drill program. We came across some really interesting intercepts, and it was really on the back of those intercepts that we made the decision to go ahead and to upgrade the resource. But as part of that exercise, we ended up getting into a discussion about what we call the economic cutoff grade for our resource. So previously on our historical resource, we had a 37.5 million pounds resource with a 300 ppm cutoff. We made the decision in this new resource to drop that cutoff grade. So we've moved from 300 ppm down to a 200 ppm cutoff grade. And the reason why we've done that is, first of all, the increase in the uranium price obviously makes lower grade ore more economic moving forward with. So that was one of the things. But the other one is the ore sorting technology that we've been talking about, where we can take lower grade material, put it into this ore sorting unit, be able to select the higher grade rocks and reject the lower grade rocks, so we can increase the grade of the feed material to our plant. Now, that is a relatively inexpensive piece of equipment to operate. And because we've now included that in the flow sheet, less or lower grade material now becomes more economic. So it's a combination of both dropping the resource grade and also extending the mineralized zones within the resource that have allowed us to increase that resource to 46.3 million pounds.
That's great. And expanding that conversation a little more broadly, can you offer insight into your pathway to recommence production at the Kayelekera project there? And I'm just going to pull this up from your investor presentation, if you don't mind breaking this down briefly.
No, that's fine. So this exploration work that is in the top line over there, the majority of that has been completed. We're still doing a little bit more on some of our regional exploration areas, and that'll come to the end in probably second or third week of March, I think. The resource upgrade has been completed. So that's the second line there, the Kayelekera resource upgrade. We've also completed our drilling at Livingstonia, which is again another regional exploration target. The samples are on their way to the laboratories now, and we expect to receive the assays within the next couple of weeks. And on the back of that, our expectation is we'll be able to do an upgraded resource for Livingstonia. That'll then be combined with our Kayelekera resource to form the global resource for the company. Our feasibility study is ongoing. We're full speed into that now at the moment. We've got mining studies going on. We've had engineers visiting site to do the inspection of the equipment, to confirm whether the $50 million for the refurb of the cost is still relevant within today's market. We're busy with our offtake agreements. So our sales and marketing exec, who's based over in the US, is talking to all of the utilities. We're starting to receive a number of requests for proposals from these various utilities. So we're starting to get a bit of a sense of what the market looks like. However, those offtake agreements will really only ramp up after we've completed the feasibility study, because a number of the utilities would like to see the results of our feasibility study so they can understand our cost structures and also understand our production profiles before we enter into real serious negotiations around offtake. We also expect at the same time that we're getting towards the end of our offtake agreements, we're going to be starting to have the discussions around financing, and whether that be debt financing or whether it be equity financing, we're not sure at the moment, but it's likely to be a combination of both. Now, depending on the results of our offtake agreements, depending on the results of our financing discussions, we would then be able to make a final investment decision, which is the point that we then use to move forward into the capital expenditure for the refurbishment of the plant. But we are being very, very emphatic about this, that final investment decision will only be made when we've received an appropriate uranium price. So we don't want to bring the asset back on too early when the prices are still low. We would actually prefer to wait for the prices to go up to a level that we think is the right price for Kayelekera, and only at that point make the final investment decision and kick off the refurbishment work and those types of things.
That's great. I think you offered some pretty incredible insight there, and we might as well just expand this view out a little bit farther, because between geopolitical tensions, I mean, it seems like all the inflation and logistics problems have kind of been shrugged under what's going on with Russia here. But do you have any insights on the kind of global market exposure? Depending, I don't think obviously it impacts your operations outside of Australia there, but any insights would be great.
Yeah, I think the inflation thing and the logistics are potentially an issue going forward. I think we are a little bit fortunate in that maybe when we look, say, when we talk about the refurbishment of the plants and we're going to be doing a larger capital spend and all that, that obviously only starts off in 2023. And hopefully some of these inflation pressures and some of the logistic issues might have been resolved by then. Although we do know, and we've been looking at other projects around there, that inflation has been impacting some of the capital costs of projects. And we've heard numbers of somewhere between 10 and maybe even as high as 30% in some areas for new greenfield projects in terms of how this inflation and the logistics have impacted costs. I think we're a little bit protected some way, because from our perspective, the refurbishment costs are not so much the purchase of new equipment, where most of the increases have been seen, but it's more things to do with things like labor costs. So we've got to do, and I'll pick an example, painting, or, removing corrosion, or doing a small amount of replacement of stuff, servicing pieces of equipment, and those types of things are where the majority of our efforts are going. And those activities or those costs don't seem to be impacted quite as much as things like capital equipment. So I expect there is going to be an impact of inflation, but I don't think it's going to be as big as people are seeing in some of the other projects out there. Logistics will be an issue, but again, I think within a year's time or so, I expect that the logistics would have improved, and hopefully will come out, won't be too serious for us during our restart either.
I appreciate those insights, Keith. I'm sure the investor audience here also appreciates you looking forward and kind of baking some of those into your forward-looking ideas and guidance here. But thanks so much for your time today.
Thanks very much.
Always a pleasure. On that note, folks, I pass the question off to you. Let us know what you think in that comment section below. Consider subscribing, because as these resource estimates and updates come down the wire, we'll update you here. But stay cool, stay awesome. And as always, I look forward to catching you in the next one.